Get your free copy of the complete tutorial at www.teachucomp.com/free.
When a customer makes a purchase, even when on credit, the accrual principle dictates that the revenue is to be recorded in the accounting period when the purchase was made. Most companies extend some amount of credit through invoicing. When a customer agrees to pay for received goods or services at a later point in time, they are often sent an invoice that they have to pay by the date specified. This date is usually either 30, 60, or 90 days from the purchase date. When the purchase is made, an entry must be made to reflect revenue earned. Since the company receives no cash at the time of sale, it will instead attribute the amount of the sale to an asset account called Accounts Receivable. Once the customer remits payment, the amount of the payment is then removed from the Accounts Receivable account and attributed to the cash or checking account. For example, let's assume that a customer makes a purchase of $100 in goods in January and agrees to pay the invoice for the sale in February. When the purchase is initially recorded, you would debit the accounts receivable for $100 and credit the appropriate income account or accounts for $100. Then, when the customer remits payment in February, you will record another entry which debits the cash or checking account for the $100 payment amount and credits the accounts receivable for the $100 payment which was made. If using an accounting software application, much of the accounting occurs behind the scenes as you create invoices and receive payments. Let's take a look at how each one of the most commonly used software applications for accounting can handle accounts receivable. QuickBooks. QuickBooks allows you to create sales invoices for customers quickly and easily. When creating the invoices, the total amount of the invoice debits accounts receivable, and the amounts posted for each line item in the invoice can credit the selected income account. Once again, this is all going on behind the scenes. QuickBooks is also very flexible when accepting customer payments. You can receive payments for items or services at the time of sale, or you can receive payments that can be matched to invoices that have been created for your customers. It can handle prepayments, overpayments, and partial payments too. When you receive a payment amount, you can select to which invoice the payment will be applied. You can also then select into which account you want to deposit the amount received. This then credits the accounts receivable account for the payment amount and debits the selected cash account by the same amount. When looking at the screenshots of the received payments and sales receipts screens in QuickBooks, note that it also includes an option to group the received payment with other undeposited funds. You can then take funds from this account to the bank later when you make a deposit. This will also have the added benefit of making account reconciliation much easier. When using QuickBooks, all recording of debits or credits is handled by the program behind the scenes. There is no other recording or posting that needs to be done by you. In fact, it can be very detrimental to a QuickBooks company file to make general journal adjustments to accounts receivable, as it will not know exactly to which invoices the adjustment should be applied. Peachtree. Peachtree is very comparable to QuickBooks in that it can record customer payments at the time of sale, and it can also create invoices and then receive payments on the invoices. Payments can be applied to the oldest outstanding invoice, or you can select to which invoices the payment amount is attributed. Excel. Once again, you have the flexibility in Excel to create your own accounts receivable spreadsheet. You have complete control over the layout and design, just as you would in a manual accounting system that uses paper. If creating an accounts receivable ledger in Excel, you would probably want to include columns for the customer's name, the invoice or job reference number, the date the invoice was sent, the date it is due, and the amount. Then you would want to customize it as required for your own business needs. For example, if you offer early discounts for your customers for early payment, you would want to add a column for the date by which the payment must be remitted in order to receive the discount and the amount of the discount. You can then post this journal's information to your general ledger using customized Excel formulas. Keep in mind that with knowledge of Excel, you can create formulas that can join all of the necessary information together between spreadsheets. Having a good working knowledge of Excel combined with knowledge of the necessary accounting practices would allow you to build your own tailor-made accounting system.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.